Diversification. Have you ever wondered how to reduce risk in your investment portfolio? If so, you're certainly not alone. Many investors, both new and seasoned, grapple with this question. Today we're going to delve into a strategy known as diversification, a fundamental principle that can help you manage risk and potentially enhance your returns over time. Think of it this way. Imagine you're at a buffet. You wouldn't pile your plate with just one dish, right? Instead, you'd probably sample a bit of everything. That's diversification in a nutshell. By spreading your investments across a variety of assets, you reduce the risk of your entire portfolio collapsing if one investment doesn't perform well. Now, let's relate this to the real world of finance. Picture your investment portfolio as your plate at that buffet. If you put all your money or all your eggs in one basket into a single stock and that stock crashes, your entire portfolio will take a hit. However, if you spread your investments across different stocks, bonds, and other assets, you reduce the risk of one poor performer dragging down your overall returns. Importantly, diversification isn't just about having multiple investments, it's about having investments that react differently to the same economic event. For instance, when the economy is booming, stocks tend to perform well, while bonds may not. In a downturn, the opposite could be true. By holding both stocks and bonds, you can potentially offset losses in one with gains in the other. Remember, diversification is not about chasing the highest returns. Instead, it's about achieving a balance that aligns with your investment goals and risk tolerance. It's a strategy to help you weather the inevitable ups and downs of the market. Diversification, in essence, is spreading investments across various assets to reduce risk. It's like an insurance policy for your portfolio, helping you to mitigate potential losses and smooth out your returns over time. As we delve deeper into this topic, we'll explore various types of diversification and strategies to achieve it effectively. Stay tuned. Did you know there are different types of diversification that can help you manage your investment risk effectively? Diversification isn't a one-size-fits-all strategy. Depending on your goals, risk tolerance, and time horizon, you might lean more towards one type of diversification than another. Let's explore three primary types: asset class diversification, geographical diversification, and sectoral diversification. First, let's talk about asset class diversification. This is the process of spreading your investments across different types of assets, such as stocks, bonds, real estate, and cash. The idea is that different asset classes perform differently under varying market conditions. For example, when stocks are underperforming, bonds might be doing well, helping to balance out your overall portfolio performance. Moving on to geographical diversification. This means investing in different geographic markets around the world. Why? Because economic conditions, political climates, and market trends can vary greatly from region to region. By spreading your investments globally, you're not putting all your eggs in the basket of a single country's economy. Finally, there's sectoral diversification. This involves spreading your investments across different sectors or industries, such as technology, healthcare, or energy. Each sector reacts differently to economic events. For instance, during a tech boom, technology stocks might skyrocket, while other sectors remain stable or even decline. By diversifying across sectors, you're banking on the fact that not all sectors will perform poorly at the same time. Now, keep in mind, these aren't mutually exclusive strategies. In fact, a well-diversified portfolio typically includes a mix of asset classes, geographical locations, and sectors. It's about finding the right balance that aligns with your investment goals and risk tolerance. Remember, the goal of diversification isn't necessarily to boost performance, it's to reduce risk. It's about smoothing out the ups and downs of your investment journey, making the ride a little less bumpy. Each type of diversification offers a unique way to spread risk and maximize investment potential. So take the time to understand these strategies and consider how they might fit into your investment plan. Now that we understand the types of diversification, how can we put these into action? Let's explore some strategies for diversification that could help you spread risk and potentially increase your returns. Firstly, consider investing in different asset classes. This means spreading your investments across equities, bonds, commodities, real estate, and even cash. Each of these asset classes has its own risk and return characteristics, so when one is down, the others may be up, helping to balance out your portfolio's overall performance. Secondly, think about geographical diversification. Global markets don't always move in sync. While one country's economy might be struggling, another's might be thriving. By investing across different regions, you can take advantage of these varying economic cycles. For example, you could have a mix of investments in established markets like the United States or Europe and emerging markets like Brazil or India. Thirdly, sectoral diversification is another key strategy. The economy is made up of different sectors such as technology, healthcare, finance, and consumer goods. Each of these sectors responds differently to economic trends and events. By owning a mix of stocks from different sectors, you can potentially reduce the impact of a downturn in any one sector on your overall portfolio. Remember, a well-diversified portfolio doesn't just mean owning a lot of different investments. It's about owning the right mix of investments that align with your financial goals and risk tolerance. You need to carefully consider the potential risks and returns of each investment and make sure they're balanced in a way that makes sense for you. Also, it's important to regularly review and adjust your portfolio as needed. Market conditions change, and so might your financial goals. Regular rebalancing ensures your portfolio stays diversified and aligned with your objectives. In conclusion, diversification is not a one-size-fits-all strategy. It requires careful planning, ongoing management, and a clear understanding of your financial goals and risk tolerance. But when done right, it can be a powerful tool in managing risk and potentially enhancing returns. Strategically diversifying your portfolio can help you navigate the turbulent waters of the investment world. So, take the time to build a diversified portfolio that's right for you. Diversification brings numerous benefits, but one should also be aware of common mistakes. Let's delve into the pros and cons of this investment strategy. Firstly, diversification reduces risk. By spreading investments across different asset classes, sectors, and geographies, you're not putting all your eggs in one basket. If one investment underperforms, others may perform well. Balancing out your portfolio, it's like a safety net, catching you when individual investments trip. Secondly, a diversified portfolio has the potential for higher returns. Different investments perform well at different times. By diversifying, you can benefit from the peaks of various markets and sectors, thereby enhancing your overall returns. Thirdly, diversification offers protection against market volatility. The financial market is like a roller coaster, full of ups and downs. A diversified portfolio can provide smoother rides, absorbing the shocks of market fluctuations. However, it's not all sunshine and roses. There are common mistakes that investors make when diversifying their portfolio. Over-diversification is one such error. While diversification is important, there's a limit. If you spread your investments too thin, you may not be able to monitor them all effectively. Moreover, the potential gains from your star performers could be diluted by the sheer number of investments. Another common mistake is lack of research. Diversification isn't a random process of picking different investments. It requires thorough research and understanding of each asset class, sector, and geography you're investing in. Investing blindly in the name of diversification can lead to unexpected losses. In summary, diversification is a double-edged sword. On one side, it offers reduced risk, potential for higher returns, and protection against market volatility. On the other side, if not done correctly, it can lead to over-diversification and unexpected losses due to lack of research. With careful planning and mindful execution, diversification can be a powerful tool in your investment arsenal, helping you achieve your financial goals while protecting you from undue risk. In conclusion, diversification is a key strategy for any savvy investor. We've walked you through the importance of spreading risk across various asset classes, geographic regions, and sectors. We've highlighted how diversification can not only help buffer against market volatility, but also open doors to greater potential returns. Don't let your investments be a one-note song. Let them be a symphony where each instrument plays its part. Remember, diversification isn't just about spreading risk, it's about maximizing potential. Happy investing!